All right, let's jump straight into this explainer. Today, we're doing a bit of a financial autopsy on Bank of Hawaii's Q1 2026 earnings report. Now, if you follow regional banking, you know it's been an absolute roller coaster lately. But Bank of Hawaii just dropped a set of numbers that, well, on the surface, they look like a letdown. But if you look just a little bit under the hood, it is an absolute masterclass in balance sheet management. We're going to strip away the headline noise and look at exactly what's going on inside. We're starting right out of the gate with this number. $1.30. That's the bank's diluted earnings per share for the first quarter of 2026. So why does this specific number matter so much? Because it missed Wall Street's $1.33 consensus estimate. And you know how it is in the hyper-reactive world of bank earnings. A measly 3-cent miss can send shockwaves through the market. It triggers that classic knee-jerk, sell first, ask questions later reaction Wall Street is completely famous for. Which brings us to the core tension of this explainer. How exactly does a regional bank expand its profit margins, significantly lower its deposit costs, and somehow still miss Wall Street's expectations? It sounds totally contradictory, right? Usually, margins go up, costs go down, and earnings easily beat estimates. So, what actually went wrong? Or maybe the better question is, what is the market completely misunderstanding here? Let's move right into Section 1, the symptoms, and take a hard look at those top-line headline numbers. Looking at the financial summary, the source of that initial shock to the market is pretty obvious. Net income came in at $57.4 million. Compare that to the $60.9 million they posted the prior quarter, Q4 of 2025, and yeah, it's a clear, undeniable drop. Earnings per share similarly fell from $1.39 down to that $1.30 figure we just talked about. If you just stop your research right here, like a lot of casual observers do, you'd think the bank is losing momentum. But as we know, we've got to dig a lot deeper. Because if we move on to Section 2, the vitals, we're decoding the net interest margin. And the underlying health of the bank tells a completely different, much more optimistic story. To really get why, we have to look at net interest margin, or NIM. This is literally the ultimate engine under the hood of any bank's profitability. You just can't evaluate a regional bank without obsessing over this one metric. NIM tells us exactly how effectively the bank is running its core business model. Think of it kind of like a grocery store. NIM is essentially just the markup. It's the vital gap between the cost of the interest the bank pays out to you for your deposits, their funding cost, and the higher price of the interest they receive from lending that money out for mortgages or commercial loans. Widen that gap, and boom, the bank makes more money on every single dollar flowing through its doors. So here is the absolute game changer. In Q1, Bank of Hawaii's NIM actually expanded for the 8th consecutive quarter, hitting 2.74%. That is a fantastic 13 basis point improvement from the previous quarter. Let me just emphasize how incredibly rare that is right now. In a macro environment where so many banks are actively struggling with shrinking margins because of high funding costs, Bank of Hawaii is structurally widening its markup. The engine is not stalling out. It's actually generating way more horsepower. So how did they actually pull this off? Management hit a few key levers to get this impressive margin expansion. First off, their deposit rates dropped by 22 basis points. This was a delayed benefit from the Federal Reserve's interest rate cuts back in late 2025. They successfully lowered what they pay to depositors, which completely wiped out a slight 4 basis point decline in earning asset yields. On top of that, they're constantly benefiting from fixed asset repricing. Basically, those old, lower-yielding loans are finally rolling off the books and being replaced by new, highly profitable ones. What's really fascinating here is that they aren't just getting lucky with interest rates. They are actively managing this. Looking at the balance sheet optimization, you can see management aggressively repricing fixed-rate loans and shifting swap compositions to push toward a massive structural margin goal of 3.25 to 3.5% by 2028. This isn't a happy accident, folks. It's a highly deliberate multi-year strategy playing out right in front of us. So let's look at Section 3, the treatment. Because if the core lending margin is that healthy, what on earth caused the earnings miss? We have to look beyond the balance sheet. Looking at the data for non-interest income and expense, the culprit is pretty obvious. Non-interest expenses spiked to $116.1 million for the quarter. But when you unpack that number, you see it was driven heavily by seasonal payroll taxes, which happen literally every single year, and a one-time $3.5 million charge for accelerated stock vesting tied to retirements. In other words, the earnings miss was not a failure in their core banking business. It was caused by temporary, non-recurring accounting charges and normal seasonal expenses. The underlying business is actually thriving. Still, management knows they can't just ignore rising operational costs. To outpace these expenses over the long term, leadership is heavily focused on future-proofing. They're actively integrating AI to drive operational efficiency and streamline digital contracting. Plus, they're aggressively expanding their wealth management services. While they aren't expecting material revenue impacts from wealth management until 2027, they're planting the crucial seeds today to diversify revenue away from just interest-based income tomorrow.
All right, let's head into our final section, Section 4, the prognosis, to see exactly how Wall Street analysts are diagnosing this mixed bag of results.
The data here lays out an absolutely fascinating paradox. Check out the numbers from Zacks Research. Following the Q1 report, they aggressively upgraded their earnings estimates for Bank of Hawaii for the next 2 years. They bumped Q2 estimates up, they raised full year 2026 from $5.45 to $5.69, and pushed 2027 estimates completely over the $6 mark. The analysts clearly see the margin expansion working, yet despite all these upgrades, they stubbornly maintained a super cautious hold rating on the stock. Why the hesitation? It suggests Wall Street loves the numbers, but they're just too timid to pull the trigger on a buy until they see definitive proof the bank can actually control those non-interest expenses. But sophisticated analysts know that to cut through the temporary noise of seasonal expenses and one-time stock vesting charges, tangible book value per share is the ultimate metric to watch. It strips out all the intangibles and shows the genuine hard value of the bank's equity. Unlike EPS, which can sometimes get a little muddied by accounting flexibility, tangible book value per share resists financial engineering. And for Bank of Hawaii, their overall capital levels and asset quality remained incredibly pristine, safely supporting strong long-term book value compounding. Which leaves us with this final thought. When you balance steady core growth against uncertain economic headwinds, is Bank of Hawaii's 3.6% dividend yield the ultimate safe haven for your portfolio right now? I mean, they're aggressively widening their profit margins. They have incredibly strong credit quality, and they're paying you a solid dividend to just sit and wait while Wall Street catches up to the underlying math. It's a seriously compelling situation. So what do you think? Are you buying the dip or holding out for more proof?